Well, hello everybody. It's time. Let's go. Market Monday, 6 p.m. You've been watching this show for a little while. You know it's time to go. We are here every Monday night kicking off the trade week here on Tradeway TV. Our friends on Facebook and YouTube joining us. We got programming every day through the week, kicking it off. Our most popular thing that we do here on Market Monday, it makes sense. It's Monday. We're talking about the market. That's what we do. We talk about the market. We help folks just like you understand the confusing world of finance. Wall Street has built it up in a way where they're like, oh, it's so confusing. It's so complicated. You need us. You need us. Well, there are certainly people who can be very helpful. But if we understand more on our own, we can be more powerful participants with our money in the markets. Whether we're doing long-term or we're talking short-term trading, we do both over here at Market Monday. And we want to help folks like yourself know how to do just that. Tonight, obviously, going to do something in the markets, right? Well, we're going to do a market update. As I said, it's the most popular thing we actually do. We do all kinds of topics on here, right? All kinds of topics, Q&A, things like that. But just getting into what's going on in the markets right now. What do I need to know? Particularly important because as the fear level has risen among retail investors and just folks like you and me, non-professionals, Wall Street professionals. I read an article actually this morning that said the bearish sentiment. Now, bearish sentiment, meaning the negative perspective that retail traders, that would be you and me, right? Just folks who have a trading account or just have a 401k, IRA, self-directed, things like that. Those would be the retail traders have a bearish sentiment, a negative outlook on the economy and stocks that match, I'm going to take this off the screen for the start here, that match 2008, right? The expectation of a bearish move in the markets, of a bearish trend in the markets over the next year is as high right now among retail traders as it was in 2008, according to the latest polls, right? This was an article in CNBC this morning. And what that means is there is a massive expectation of negativity. There is a bias. Traders always come to the market with a bias. To the best of our ability as investors and traders, we don't want emotions to close our field of vision. Where I'm like this. See, I can't see what's over here now. I can't see what's over there. This is bias. It does that. When I work with traders, one of the things we're really trying to get rid of, to minimize, is fear. Because fear, whether we're talking about trading or anything else, anytime you and I have a fear response in the mind, okay, it does this. It closes our ability to focus on all the information, and it pulls it in and it fixates on the information that confirms the threat that we perceive. Now, because trading has inherent risk, doesn't mean it has to be fearful. This is the difference between people who are being trained and people who are just going for it. Where are the emotions? That's part of training the trader. I say it all the time. You got a road, you got a car, but the most important part is the driver, right? So that bias is real. Now, it's not always fear-driven, but certainly, oh, I just lost my light here, guys. Gonna plug that in. It's not always fear-driven, but there's always a bias. We want to minimize that bias. And that's something I want to talk about tonight, because we've talked on here a lot where it's a particularly bearish outlook. And I think there are, by the way, when I say bearish, for those of you who don't know, When we talk bearish, we mean down, stocks going down. The bears sell. That's a bearish move, selling. Okay. So when I say bearish, I mean downward movement. If you owned stock, you would want it to go up, right? That would be bullish momentum. But there's a lot of bearish pressure, downward pressure, because the economy is shrinking because of what the Fed is doing. We've talked about that at length, and I'm going to recap that quickly tonight. But I have a little bit of an update because I mentioned to one of the other coaches here at Tradeway, right now, as we go to the markets, which we'll do in a minute, we'll go and look at the chart of the S&P. As we're approaching 4,200, I am cautiously bullish. I am shifting a little bit, cautiously bullish. I'm not taking the bearish warning off the table, okay? But I am saying there's reasons to just temper that extreme bearish look a little bit, at least in the short term. Remember, we're always talking on here about investing and trading. They're not the same thing. They're not the same skill set, and they're not the same time frame. Okay? A long-term bearish outlook is really going to be something that's more useful right now for our investments. What's going to happen to my investments? Right? Should I be rotating? Is there something I want to move to cash? Do I want to hedge with put options? Right? My portfolio and protect that. Should I be sounding the alarm if there is that heavily bearish look? Interest rates are still working their way through the system. What is going to be the effect of that? Most Americans don't necessarily understand how the Fed works, what it is, what they do, and how that puts pressure on the markets. But they do know the headlines talk about possible recession, right? Inflation, prices are getting higher, okay? Bank CEOs warning of coming recession, this kind of a thing. Oh, it's going to be bad. It's going to be bad. It's maybe, right? All the mixed reviews. So we hear that, and then the fear goes up, and they anticipate stocks to continue to go down. I want to be clear. There is definitely an expectation, an anticipation that we're going to see stocks continue to move down. As an investor, that's important to know. Do we buy insurance because we know what's going to happen? Or do we buy insurance because we don't know what's going to happen? Right? We buy insurance because we don't know what's going to happen. Now, I want you to look at this here. I'm going to go out to a year, right? That's what we've been doing for a year now. Literally in a year. This is back here on the beginning of this chart, okay? That's May 2nd of last year. We are literally at the exact same point we were last year. So in an entire year, if your portfolio just sat there, it returned 0% minus inflation. That's what it did in a year's time, just flat. So this is why we also go, well, wait a second, there's ways we can use stocks to take advantage of those shorter term price movements, utilize different trading tools that we talk about here on Market Monday all the time, so that we can actually make some money in this time, okay? Difference, investing and trading. The longer term, though, we're still looking at forecasts a recession by the end of the year, right? How bad? Depends on who you ask. We talked about this on an episode 2 weeks ago, the 3 things that I think the longer term outlook, the longer term investor should be paying attention to in the news. Cut out the rest of the noise. We don't need all the news. Those are the 3 things you should be looking at. If you were there, you know what I talked about in that episode. You can always go back and you can look at that on YouTube. Everything is posted there as always. But that's the main things I want you to look at. I will say the optimism in the market remains pretty resilient, right? Wall Street is looking to be opposite in some ways to that high bearish outlook that retail traders have been committed to, right? They are looking to trade the market the other way. And we can see that institutional investors are pushing this market up, right? We came back down to this 3,800 level, right? Now, this is in March, right? Mid-March, and they've pushed it all the way back up. Now, today isn't a big surprise. Let's zoom in again, right? They tried to push it up and it failed. Why? Is it magic? No. This is a level they've pushed it to multiple times, right? It hit here, it tried again, it failed. It hit there, it's trying again. Is it going to drop all the way back to 3,800? Well, we don't know. But we do know that earnings has been more resilient in two ways. One, over 3/4 of the companies that have reported so far in this earnings season have beat their forecast. Now, they haven't all come in yet, so we'll see how that shakes out at the end of earnings season. We got a lot of earnings reports coming this week. But what Wall Street is doing is going, are companies still growing? So if you're concerned about a recession, you go, okay, well, are companies really shrinking as aggressively as some are worried they might be? Because if they do, what can happen? Well, they can start to do layoffs. Wall Street starts to lose confidence in the growth of those companies and it sells stocks. The market moves down. If that happens, it pulls down on your 401k, on your IRA, on the stocks that you may be invested in, right? That's that bearish downside. But we just haven't seen companies shrinking quite as much as expected. In fact, here's an interesting number. Companies reporting earnings this quarter were expected to be down, right? They were beating the estimates. Follow me, right? The analysts make estimates. XYZ stock is going to make this per share, and it beats it. That tends to be a positive for that company. Oh, it beat it, but it's still down from where it was last quarter. This is where it gets kind of wacky, in my opinion, right? This is where things get confusing for people like you and I, where it's like, well, wait a second. You're saying they beat the estimate, but they still shrunk from last quarter. But here's the resiliency of the market right now. They're saying, yeah, overall earnings was expected to contract by about 5%, right? Overall, it would be down 5%, but they're finding, no, maybe it's only going to be down about half that, 2.5%. So they're taking bad news and it's good news. When bad news is good news in the market, don't make the mistake of thinking that good news is always going to play out with positive momentum in the market. Sometimes good news is bad news to the market. Sometimes bad news is good news to the market. That's why we did a whole episode going, this is how we understand the news as investors and as traders, because it's different. It's not how most people think news is going to work. And this is a key that you can have in your back pocket as an investor, as a trader, to help you navigate and not get caught in some of the traps that financial news can get us in if we don't understand how this works. They're actually taking bad news. Oh, wait a second. Earnings have gone down, but not as much as we thought. Why? Because they still want to buy. The market is still optimistic, right? Stocks have come down from last year. They've been channeling all year. You can see this here, guys. Like, let's look at a longer view, right? I can see the market went down in 2022. And now, even though there's volatility, they're just not really letting this thing tank. It's not going down. There's not enough positivity to really let it go back to where it was. But they're also still in this question mark. The labor market remains strong. Corporate earnings still coming in pretty good. Now you said, well, Blair, pretty good. They're down. Yeah, they're down, but they're not down as much as they thought it would be. And if companies just really aren't taking the big hit that Wall Street maybe thought they would, or they're not yet, right? then they're not going to sell off. They're happy to buy stocks in the short term. And they're continuing to do that. For my traders out there, you'll notice this box I have drawn puts us in the 4,200 area. This is a significant area. Even though back here, this is August of last year, we broke through that, hit the 200-day moving average, and then dropped down. You had an extended move on the top. You had an equal move on the bottom there where it broke through for a bit, did that double bottom, and then recovered back up into the range. We've basically been running 3,800, 4,200 for about a year now. We're right in that 4,200 range. A push above 4,200 here on positive expectation. I just zoomed in too close. On positive expectation here, I think actually would be pretty significant because you'll notice back here where I had it highlighted, it hit that 200-day moving average. Whereas actually we're above the EMAs right now, right? So that puts us in a position where we're not just coming right off the heels of a bigger move down in 2022, hitting that 200-day moving average and then crashing back down. Finding some momentum above this line, I think could be some good short-term momentum for traders if they're looking for a breakthrough here. However, buying at this 4,200 level, I think would be highly risky because we're really at a resistance zone. We're at a zone where the market has proven more than one time, right? We were looking for 2 points make a line, 3 points make a trend. We want to see that resistance be broken before we're going in there to really do anything with that, because we don't want to get stuck holding the bag and going, well, wait a second. I anticipated a breakout, but I bought too early. I'm at resistance, and now the market's falling back towards the 3,800 area. Now it's already fallen to the 50, and we got a really nice recovery off the 50, biggest day since January on Thursday. That would have been on Thursday. So for my short-term people, you understand that we're coming in here and we're looking at each one of these moving averages just like a floor in a building. We're just going to move from one to the other, up and down, right? But in this case, we're actually on top of all of those right now, trying today to push through that horizontal line there, but not able to do it. Definitely watch out for 4,200 if that breaks above it for those short-term positions. If they begin to sell off there, we want to make sure we have that on the radar, okay? Looking into the end of the year, we've got to know Fed is coming up this week, okay? Fed is coming up this week. I see your question there, Ruth. I'm going to comment on that in a second. So you got to know that the Fed will be releasing their statement on Wednesday, 2 p.m. Eastern, as they always do. So that is going to probably create some volatility in the markets. Of course, I wouldn't expect a whole lot to happen tomorrow. Potentially a sell-off later in the day. I don't have a crystal ball. I say that because right now I've noticed Wall Street is tending to take the risk off the table on impending news. They're chopping sideways, and then right before the news, they tend to pull back. Because things are a little bit more fearful, they're taking risk off before those announcements. That may happen earlier in the day on Wednesday. And then the Fed will announce their rate hike decision, and then Powell will give a comment on Tuesday or Wednesday afternoon. It's a Fed week like all Fed weeks, right? Really looking to see if the Fed is going to say, this is what they want to hear. This is what the news is always looking to hear. What's your outlook? Are things getting better? Are things getting worse? Are you going to keep raising rates? If there's an anticipation that they're going to slow down raising rates and that corporate earnings are going to continue to be fairly strong, then there's a pretty positive outlook on the S&P for most investment banks, the projections they're making to the end of the year. So there's some conflicting information where you and I can go, all right, let's take our skill set of learning to read a chart and let the chart tell us what's really happening, right? What's really happening is on the price chart. It doesn't lie. It tells us who's putting their money where their mouth is, right? If they're buying, we're going to see it on that chart. If they're selling, we're going to see it on that chart. So they can say what they want to say, but you and I have a skill set to be able to come in here and go, okay, let's see what they're doing, right? That's what we want to know. Ruth says, is it possible that layoffs are allowing for some of these positive earnings? This is a great question. It's very insightful, actually, Ruth, because the reality is remember I said good news, bad news, bad news, good news. Well, sometimes a company lays people off to what? To lower expenses, right? If a company's lowering expenses, well, if they're laying people off, that's not good for the people who are getting laid off, but it might be good for investors. If that strengthens the outlook of revenue and earnings for that company, the investor is going to have a vested interest in seeing that happen at times, because that could actually mean for the long-term health of the company. So those kinds of things that are bad news to a specific group of people may not necessarily be bad news to investors. If companies are cutting costs, then that may be seen as a responsible decision for the long-term health of the company, which investors may be happy with, right? Strong, good leadership, good decisions like that, eliminating waste, cutting, giving them a healthy outlook for the future, maybe in times of economic contraction, which we are in, whether we have a big recession or not. We are in a time where the GDP is contracting. In fact, I have to say, last week, this was the resilience of the markets I'm talking about. GDP numbers came in half, gross domestic product. That came in half of what Wall Street expected it to be. That's the growth of our economy. The productivity of our economy came in at half the projection. But because the Meta, Facebook earnings were so strong, tech took off and the market went up, biggest day it's had since January. This is why traders don't primarily look at the news. We're just going to look at the price. News tells traders volatility expectation, not directional expectation. Okay. They weren't really paying attention to the GDP data, not nearly as much as I thought they were going to. They caught on to Facebook earnings and off it went. They were happy to buy from there. Now, some would say that the buying and the resiliency and the hope is completely unfounded, and eventually the bottom's going to come out of the boat. Well, that may happen. That may happen. That is why I am cautiously looking at bullish in the short term, but it's still a bearish outlook, right? We could still see some lower lows here at any time. We just don't know how the Fed raising rates, which they're expected to continue to do this Wednesday, is going to be working through the economy. I've said this on here like this before. I took the wrong one off there. If you go out and you sip a coffee, right? You're just sipping on a coffee. What's in the coffee? Caffeine, right? There's a stimulant in the coffee. If you sip that, over time, that caffeine is going to hit you a little bit more and 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 a little bit more. If I go out and I drink a quarter of it and then another quarter and then another quarter and then another quarter, I'm drinking it that much faster. Those intervals, when it hits me, it's not going to hit me instantly. That's not how it works. Some of us will metabolize that faster, but as a whole, human beings, it's not going to hit us instantly, right? It's going to be little pieces. But caffeine will peak at some point, about 30 minutes after we take it, typically it peaks. Now, if I took a half of it, and then a half of it, and then a quarter, and a quarter, and a half, and a quarter, those bigger doses I took, they're not going to hit me right away, but they will hit, and they'll hit bigger. And over time, see, caffeine, this is like a whole teaching thing on caffeine. Caffeine has a half-life of 6 hours, meaning it cuts in half in your body every 6 hours. What am I saying? You're adding stimulus to the body in different measures and doses. It's going to show up in different ways, and it's going to compound over time. This is what they're doing to the economy, right? They're adding this in doses, except in this case, they're no longer stimulating it. They're trying to inhibit it, but it works the same way. So we don't know what's going to happen. How's this going to hit us? The reason I believe we're not already feeling much more confident of a much deeper recession is because in this case, Ruth, interesting question, right? I'll put it up there again. In this case, we've got so many jobs after COVID We've never really been in a spot quite like this before. So I have noticed more layoffs happening. The economy is contracting, and that does mean that we are losing some of those jobs that we had. However, we've had so many, we can easily absorb it. Whereas perhaps in a situation in the past, we would not be able to absorb it quite so easily. And that's when folks stop bringing in money. And that's when the economy can really start to tip. Then the contraction gains traction. It snowballs because consumer spending drops. And then fear goes up. And then consumer spending drops, not because people aren't working, but because they don't want to spend their money. And it becomes a self-fulfilling prophecy. And then companies make even less, they lay off even more, and it snowballs. And that's how we get big recessions. Now, typically there's some kind of a catalyst, and there are certainly people out there who are saying there are catalysts. I read today a commercial real estate expert just talking about how there's actually a lot of risk in the commercial real estate sector. Nothing like it was in 2008, but unusually high for different reasons. So you'll hear that kind of stuff. Again, we're looking at what matters to the trader in the market in particular. And then over time, like I said, I've got that episode on 3 things you want to go back and watch if you're a long-term investor in the markets and you want to bring down some of that fear level. That's what we want to look at and make sure we're aware of. Okay. Now, that said, I want to go in here and I want to just show you guys something that we're doing on our community pages. I'm going to stop my screen share. I'm going to open up another window for you. This is our Tradeway community page. I just want to show you guys. This is one of the things we're doing in here. I was going through a watch list today, and I want to just show you because I know some of you guys, you've not really had exposure to this. For most of us, this is one of the game changers for a trader. Okay, that we didn't know. And what happens for traders who have access to tools, which, by the way, because of the internet, you and I have access to amazing tools. And what we're doing is we're going in and we're simply looking for what we call technical patterns. Now, there's a skill set we learn to use around these technical patterns. But these patterns, because humans buy and sell in patterns, because supply and demand forces these patterns to be reproduced over and over and over again, we simply go in, learn to begin to recognize the patterns, and then we exploit those patterns by buying and selling in and out of them. You'll notice here I've got a pattern on Apple. What's happening? It moves up, back down, right? Up to the red line, up, back down to that white line, up, back into this line, back up. So what am I doing? I'm waiting for another move back into that line, right? This is what we call an uptrend. I keep going, okay? Here's Amazon. Moves up off that line, back into the line, up, back down into this line, right? Right at this point right here. Moving down. Not all patterns are created equal, by the way. Some of them are better than others. Some of them are clearer than others. This is what we call a downtrend. Peaks and valleys, guys. Just imagine the peaks and valleys. Instead of going bottom left to top right, this one goes top left to bottom right. It hits the top, it goes to the bottom. It hits the top, it goes to the bottom. Hits the top, goes to the bottom, hits the top. Actually comes up here, tries again, doesn't work, hits the bottom, goes up. And today it's bouncing. This was taken today, bouncing down off the top, right? And with options, this is one of the patterns we could look to take advantage. This one's just been doing the same thing. Okay, now this one has a little bit more complexity where it tried to fall back down to the bottom line and stopped. So we're looking to see if it can move through that again, right? Patterns, patterns, patterns. This one hits the bottom line, moves up, bottom, bottom, and it's on its way up again, right? Going out and looking at patterns, GE stock, been doing very well. 20-day moving average just keeps hitting it over and over and over and over. Got a post from a student today. She actually said, hey, thank you for posting that. I've been actually trading that stock myself. One of the things we do is we just go in and look for patterns, right? And I want to highlight on here because when I go and I look at, I'm going to stop this again. When I go and I look at the S&P, which I'm going to pull up one more time, that's what we're really looking for, right? We're looking for a consistent pattern. The most consistent pattern we have right now is the fact that it's been channeling back and forth between these two levels. It's right there. Okay, it's right there. So we really want to see a breakthrough out of that range or potentially watch it fall back down, which again, we're going to watch each moving average on the way down. We use the S&P 500 to navigate market tone, which is like driving on a road. What's the weather? Is it clear and sunny? Is it foggy? Is it rainy? Is it icy? Is it too dangerous to drive? Or can we open it up today and just go for it, right? That's what we do. It doesn't tell us that we should trade or not trade, just binary. It tells us how we should trade. And that gives us some insight on managing our positions, right? We put all those things together and we start to have enough information that is objective to make decisions that don't tell us what the market is absolutely going to do. That's not what trading is. It tells us how you and I can identify when there's edge present in the market and we can manage our risk accordingly. That is the job of the trader. Now, Ruth also says, so the layoffs today may mean some sort of recession eventually, but don't expect it this month. Yeah, so here's the complexity of that question, Ruth. What is a recession? Now, technically in the past, it's been defined as 2 quarters in a row of declining GDP. 2 in a row, declining GDP is technically a recession. But you'll remember maybe from last year, we actually got that. And a certain person in a certain political office, like anybody in a political office would, found that particularly inconvenient. Nobody wants to be the guy in charge when there's a recession. So what did they do? Well, they just changed the definition of a recession. Well, we're not really in a recession. We're not really in a recession. So the question again is, well, what's actually a recession? And what we need to know as investors long-term, right, is are we in a bear market? Are we 20% down from the highs or more? And is the market looking at a lot of fear? And are we expecting a high enough potential that we're going to make new lows in stocks, particularly on the indexes? And right now, even though this week, this month, no, I don't anticipate the stock market making new lows. Is it impossible? Of course not. But I do not think that is likely this month. You know, if the Fed came out and did something really radical, which I do not expect them to do, that would be really unusual at this point. Yeah, sure, the market would react pretty volatile, I think. But that wouldn't trigger a bigger recession. What tends to happen is the conditions in the economy become weak and vulnerable enough because of the interest rate raises that something like we saw last month where the banks fail, that can trigger panic. When something triggers panic, that can really send us into a deeper recession. If we do contract enough where people are not making the same amount of money they were and fear gets higher and they begin holding on to their money more, that is a self-fulfilling prophecy. That's where we can start to see things really contract. And then what really spills it over from there is if there are, like 2008, bad loans and people can't pay those loans when they're not making the money they used to make, right? And if they're really bad loans, then that can happen very quickly. And if there's a lot of really bad loans, then that can spread very quickly, right? Again, the little bit I read on this in commercial real estate, which is not my area of expertise, this particular individual does not anticipate that that would be as bad as 2008. I'm not making a prediction about 2008 Great Recession today. What I am saying is this is how recessions snowball, right? You and I just need to be ready, right? The stock market right now is looking fairly bullish, okay, in the short term. But you said the layoffs today may mean some sort of recession eventually. Here's the thing. The layoffs are going to need to be pretty significant because the buffer that we have of extra jobs, if people get laid off right now, in a past scenario, if people got laid off right now, they would not be able to, in many cases, just go out and get another job. I mean, that's not easy for everybody to do right now, but you can go and find a job. In a really bad recession, you lose your job, it's hard. It's hard to get another one. A lot of other people are going after a lot fewer jobs in that case. Right now, there's a lot of people who are employed and a lot of jobs open. So if you lose one, you can go get another one. Maybe not as good, maybe, but you can get another one. And that's definitely keeping consumer spending up, I think. And of course, that's keeping us afloat. And that's part of why I think Wall Street is more confident going forward, right? They're expecting the Fed to be at the end of their rate hiking cycle. So this is really just an overview, guys. Some of you guys, if you've never been on here before, you're going, whoa, this is a lot of perspective and language that maybe I'm not even fully familiar with. I don't know if I've heard this before. A good friend of ours, Myron Golden, says, learn as much as you can, as fast as you can about money. I tell people all the time, if we're afraid to have a meaningful conversation about money because we don't want to make it our God, it will always be our master. And that is not what we want. We want dollars to work for us so that we don't have to work for it, because it's already a master for many, many Christians. And all we're trying to do is go, how do I get better at money? Our vehicle is the stock market, but I try to come on here and do a market update where I give you an idea of how to lower fear, which there's a lot of right now, right? That's why bearish sentiment that I started tonight with is so high, because there's a lot of fear. Number one, bring the fear down. Number two, how can I put my dollars to work? What are some simple things I could do? We teach people how to get paid to buy stock and get paid to sell stock. Now, I don't mean you pay to buy the stock and then you get paid when you sell it. I bought XYZ for $10 a share and I sold it for $11 a share. We do that, but we can show you how to get paid extra just to buy at $10 a share and get paid extra just to sell at $11 a share. The only reason you don't know how to do what I just told you isn't because it doesn't exist, but because nobody's ever told you how to do it, right? Call options and put options are the name of the game. So there's all kinds of stuff we don't know how to do. We just want to help you understand that there are some things that you don't know how to do, that you don't have to learn in this highly intimidating environment. A lot of the content, even on YouTube, right? It's not geared to our community necessarily. And even though there's a lot of great information, a lot of it is geared towards people who are really, really into the nitty gritty of finance. And we want to help break that down for you in a way that's practical. So again, we can lower fear, get you to put some of those dollars to work and protect what you already have. Because as we say all the time in the market, it's not what you make, it's what you keep. So with that said, I appreciate all you guys. Ruth, David, thank you for commenting, throwing in the questions. I love that so much. I know that's helpful to everybody out there. If you're joining us on Facebook or YouTube, thank you so much for being here. As always, my name is Blair Nightingale. Go ahead, tag anybody that you'd like to send this to over on Facebook. You can always share the link on YouTube. Subscribe, like to follow along. We've got programming coming up every single day of the week here on Tradeway TV. We'd love to have you guys. Tomorrow is Tip Tuesday. We're going to get into the markets and do a very practical tip that you can use in your trading. We're specifically going to focus on trading, and I actually will be hosting a live trading right here on YouTube on Thursday. Normally our coach David Verbruggen is on doing that. I get to do that this week. So it's been a little while since I've been on a Thursday. Looking forward to seeing you guys then. If you have any questions, concerns, comments, feedback, anything you'd like to look at in a future episode, please write me at support@tradeway.com, Market Monday, and they will send that on over to me. I would appreciate hearing from you guys. Thank you and good night. See you guys.